And good evening. We are live. Mr. Blackhorse, I appreciate you being on tonight. How are you?
I'm doing pretty well. How about you?
Fair enough. It has been a hot week, and so that's made all of this rather difficult. But what are you going to do?
Yeah, no, it's been the hottest week of the year up here in Canada. Probably
Fair
not.
enough.
Uh, I once went to a conference in South Carolina somewhere, and I thought, I was jacket and tie. I was presenting at the conference, so I thought, maybe I'll just walk over there. It's only a few blocks from the hotel, and
Oh dear.
I cannot believe the difference between heat here and the heat in the American South. It's so every time I complain about it, I remember that experience of showing up completely drenched in sweat after walking like I don't know 5-10 blocks or something. So
Yeah, that's South Carolina is no joke. But what's the HVAC like up there? Do y'all do a whole bunch of AC or are you
well, we have AC.
okay?
Not every. My wife grew up without AC, so like not every house does. But our AC is it's designed for when it's 80 degrees outside and you want it to be 72 inside.
Yes.
It's not designed for when it's like 95 outside, so it just kind of takes the edge off a little bit.
Yeah, that's my one of my brothers. He's up near one of the Great Lakes, and he was just telling me, he's like, yeah, my kids were climbing on me this week, and I said, guys, we got to stop because we have no AC and this is not fun.
Yeah, yeah.
Yeah.
uh,
All right. Well, very good. So what it is, I am anybody that's been watching this for a minute. I think you're aware of what went on a few weeks ago, but I'll just refresh for whoever's new tonight. Good evening, Mr. Whitaker. So a few weeks ago, I was reviewing the whole Greener Pastures documentary, and I took a little digression there for a minute because most of the folks they were talking to in there were livestock folks, and livestock folks they're sort of insulated from some different issues because how not nimble they are. They can't move too much, and so their infrastructure is built up in such a way that even to change the particular livestock that they're dealing with there for a minute, it takes some time. And so if they wanted to be like the 80s or 90s, jump into ostrich or emu or whatever, it takes some time to revamp their whole system. Whereas the grain guys, the row croppers, they're right there. They have all their fields, and if they want to, most of them are smart enough not to do it. But if they want to, they can chase the Midas touch and keep changing their seeds based on speculation and on the Chicago Board of Trade. Now that's how I painted the picture. And in the midst of me monologuing, I realized that I was a little bit over my skis. I thought I had the general idea, but before I really got out there and painted the wrong picture, I wanted to slow it down. So I got a hold of a Mr. Bradlib that some folks are familiar with, and he sent me your way, Mr. Blackhorse, and said that you would be the man to talk to about investments, contracts, futures, and how all of that works. So, if you just want to start us out from very top 50,000 feet in the air, what is the CME Group? What's the Chicago Board of Trade? And what is this uh, that will eventually be impacting agriculture on the ground?
Sure. So the CME Group is a collection of exchanges that are now owned by a single group, the largest collection of futures exchanges anywhere in the world. Um, Most of the CME Group's futures trade is in physical commodities. Agriculture is a huge business for them, but they also do financial futures and future option trading and all kinds of other quite uh, there's financial futures, there's equity futures, all of those elements trade on CME as well. So there's all that piece of the exchange as well.
Now, equities, as in the New York Stock Exchange, Tesla and Amazon, those sort of equities.
Yeah, so you can trade S&P 500 futures, you can trade Dow futures. I don't know if they do single stock futures there or not, but
Okay.
certainly some futures exchanges do. And there's a whole that's a whole tangent for another time why they
Okay.
do that and why you would trade a future versus physical equities. Um, but the core of their business, or at least the historical core of their business, are a collection of continental commodities exchanges, the oil and gas exchanges, the metals exchanges, and critically for this discussion, the agriculture exchanges. Uh, Agricultural futures are the most complicated futures products on the entire CME, um, and they're, how do I put this? Um, they're the least, they draw the least interest from the financial industry, because they're very hard to price. They have, um, ultimately they have physical delivery provisions in them, and so you have to be very careful trading them if you're like a market maker coming at them from the financial industry. They're products that are actually geared to producers and consumers of particular commodities.
Yes. Now, I want to run back to commodities in just a moment, but sort of the hardness there, I'm assuming it is the pricing volatility due to shifts in the weather, due to shifts in other commodities like fuel sources, and how that impacts the transportation of the ag product. Is that fair?
Yeah, that's a big part of it. Part of it is seasonality. So there's the time value of money versus the time that the crop is actually going to be delivered in the various locations. So there's going to be natural shit. If you imagine like cotton futures, is harvested in the U.S. at a particular time. So there's a time, and it, well, cotton's maybe a less good example because it doesn't go bad. Maybe corn is a better example. It's harvested at a particular time of the year. It goes bad, so you can't keep it indefinitely. So you have to, there's going to be a natural shift through the year based on the time value of money for purchasing futures for delivery later, and based on the storage costs and all the rest of it, which makes it much more difficult to price than even say an oil future where oil production is relatively constant through the year. It doesn't. It's subject to um, it's subject to disruptions based on events, but it's not subject to disruptions just based on seasonality and the weather.
Okay, so if we can roll back 30 seconds to commodities, what is a 5-year-old definition of a commodity?
So commodities are um, any good that is produced in sufficient quantities at specific grade levels, delivered in a specific location. So when you look at a futures contract, the first thing that you're going to look at is the contract specification. The contract specification is going to tell you what the commodity is. In other words, it's I don't know, this particular type of corn, this particular grade, graded by some agricultural agency. It's going to tell you where it's delivered, and it's going to tell you when the delivery dates are for it.
All right, absolutely. Now, a question for you: when it comes to agriculture and commodities, are the commodities static in that they've already been created, or are new commodities being created all the time or being taken off the board, or how does that work with the individual commodities?
Yeah, so the CME adds and removes products pretty regularly. Um, the largest and most active products have been stable for a very long time. These are agricultural products. They have not fundamentally changed in 100 years, but there's at the edges there's contracts of different kinds that get added and removed all the time based on uh, demand and interest in the futures. And the CME's incentive is to have as many actively trading products as possible. So they're always kind of playing at the edges with whether they want to have contracts for stuff.
Yeah, because ultimately, I'm assuming they make money by skimming off the top of the individual contracts.
Yeah, they have there's fees to list the contract, and there's fees. Ultimately, they're the whole both the brokers that are their market makers and the exchange get paid as part of the process of putting the listing up. So as long as it's going to be an actively traded listing, they've got an incentive to have it up there.
Okay. Now we keep talking Chicago, and that's not the only agricultural exchange, but it is the primary one at this point, is my understanding. Is that fair?
Yeah, so the CME is a group of exchanges. It's not a single exchange. The Chicago Board of Trade is the largest agricultural sub exchange on the in the CME group. There are quite a few of them if you look into it, and they there are like several local exchanges, and not only that, there are a number of non CBOT exchanges um, that have been absorbed into that group over time. Um, Interestingly, the Chicago Board of Trade deals in things that are delivered far outside Chicago. So a lot of the agricultural futures that you see are not actually delivered in Chicago. They're delivered. If you go back in time, CBOT got its start where everything's delivery at a warehouse at this lakeside in Chicago. That's where all the pricing began. But now many of the commodities they trade are delivered in various locations around the US and around the world.
Yeah, and the big thing on it being delivered up there in Chicago, that's because they could go south, jump into the Missouri River, they could go onto the Great Lakes, they can push out to New York, they push out different areas of Canada. And so one of the interesting things in the midst of this is that there's a very practical side. It's not just ethereal. I'm sorry, go ahead.
Yeah, I mean, historically, this was all the Chicago Board of Trade and the Chicago Mercantile Exchange, the CME, got their start selling futures to consumers on the East Coast for products being grown, raised, etc., in the Mississippi Valley, delivered north along the river systems into Chicago, and then delivered from the futures exchange to consumers through the Great Lakes watershed. So where the history of it is. Obviously, the patterns of commodity delivery have evolved as transportation has evolved. Uh, but even today, there's a huge amount that is still fundamentally delivered the same way.
Yes. Now, a quick digression. How does the CBOT in particular and the CME in general, how do they affect international trade and then more particularly Canadian trade? Because did you guys at one point have an agricultural exchange in Winnipeg? Is that correct?
Yeah, we still do. Um,
Okay.
so the Winnipeg Exchange was bought by ICE, which is another probably the only competitor to the CME group in North America is ICE. They're listing in like a whole set of competitive futures products, but they own the Winnipeg Exchange, so there's a futures exchange out there as well, though it's obviously dwarfed by the Chicago Exchange. Um, Most Canadian producers, uh, well, Canadian agriculture is a bit of a different beast because we have the marketing boards up here for a lot of products that forcibly set prices and cut around a public futures exchange. So there's only so many products where you can actually list Canadian futures because of the way the marketing boards work. So it's really only like hard grains that you get futures in, and they used to list oil and gas products and that's gone in and out of fashion depending on how certain things are going in the relationship with the U.S.
Yeah. Now, is there a we're going to really travel down this digression here for a second. For the various exchange rates and then for the actual laws related to agriculture and the movement of grains or live animals or what have you, are those auxiliaries a part of ICE or part of the CME, or is that just another stage in the process where you would encounter those different
So if you've got if you've sold a futures contract to CME, part of they've got a delivery mechanism kind of built into that contract. So your obligation is to deliver to a particular location, a particular commodity. Now they have their partners who will organize delivery for you, or that you'll organize delivery in conjunction with. This is a part of the process that I'm a little bit less familiar with, but they've got like a particular warehouse that you've got to deliver to, and they will. You've got to organize transport, and um, part of making delivery is organizing transport or paying for transport.
Okay, so that would that be a contractual obligation that's reviewed then and overseen by the CME to some degree,
Yeah,
or they?
exactly. So
Okay,
they have to make sure if you're responsible for delivery on a commodity, they're going to make sure that you can deliver it. Remember, the exchange here is what's called a central counterparty. So they've got obligations to deliver on one side, and they've got obligations to receive on the other side, and they take responsibility for delivering and paying out cash on both sides. So whether you've bought 100 tons of wheat or sold 100 tons of wheat, your credit relationship is not to the farmer or to the consumer. Your credit relationship is to the CME. And as part of that credit relationship, when you engage with them, they're going to make sure that you can deliver cash on the other side, whatever the case may be.
okay. Now, who is getting? We've talked about who could be dealing with the exchange, but who is dealing with the exchange? Is this going to be primarily speculation, or is it going to be somebody like Kellogg's, or I'm trying to think of a value added, somebody that
Yeah.
would be value adding to grains or to corn or whatever,
Yeah.
Pepsi or
So,
okay.
futures exchanges have two primary participants and then kind of a secondary participant. The primary participant number one are the producers and consumers. So you'll have on the one hand um, either purchasing associations or like individual large farmers who are going to deliver actual commodity. Um, on the other hand, you have everyone from grocery store chains to like cattle feed collectors to Kellogg's to whoever else is going to be a large scale consumer who's going to sit on the other side of one of those contracts. So that's category one. They're the most important players in the futures market. Um, Category number two are what are called market makers. And their job is to sit on the bid and ask side of futures contracts all day long. And they collect money for what's called the spread. So there's a difference between the bid price for a futures contract for grain and the ask price for the futures contract for grain. And what they're going to do is they're going to sit on the bid and ask price and they're going to make the spread as because they're always there. So when you're a producer or when you're a consumer, you go to the CME futures exchange and you hit the bid and you'll get execution right away because there's a market maker on the other side. Market makers have this unique property where they're not neither a consumer nor a producer of the good in question, so they have to flatten their position before delivery date. Otherwise, they're going to be in trouble. So it's a very the price moves because the market maker moves the price, and as the market maker moves the price, they'll either get rid of the accumulated contracts they have or they'll accumulate contracts that they're short in order to balance the market. So
Now, go ahead, finish. Sorry.
so that's like a critical role from a market mechanics point of view. But in terms of the ultimate price of the commodity, what they're doing is they're producing more production. They're producing more sellers of the commodity by raising the price, or they're producing more demand for the commodity by lowering the price. And they're operating implicitly by moving the price in order to balance their contractual position. Um, so that's their role in the market.
Okay, so I want to dig into that some. When we're talking about the market maker, was that the official
Yeah,
title? Yeah.
yeah.
So are they? are they operating as God on high, basically saying that at this point for this particular period of time, this is what corn will cost. This is what soy will cost.
Well, so if you imagine yourself, you've got a bid in the market to buy corn at a dollar, an offer in the market to sell corn in the market at $1.05. And anybody who comes to you on either side of that transaction hits your bid or offer. And over the course of the day, you either accumulate corn or you get yourself short corn. So if you're accumulating corn, you're going to have to lower your bid ask spread in order to get rid of the corn you have and vice versa. So you're not arbitrarily deciding price, but your role in the market is to set where the spread is in order to get yourself flat by the end of the trading cycle.
Okay, now how does this? So one of the ways in which I'm trying to figure it out for the small time farmer,
Yeah.
and let's say he's far away from here. He's in Texas, and currently he's dealing with a drought, and he's got 50 beefs he's taken to auction.
Yep.
Is he expecting to be circling that CME price, or is the price that he's going to get at the local auction completely independent of that?
So the price that he's going to get at the local auction is completely independent of the CME price, except that uh, the CME price is a competitive price to the local auction. Um, and in many cases, if the well, certainly if the price of the local auction drifts out of sync with the CME price, people will come buy at the local auction and sell at the CME.
Yes, getting into actual arbitrage between
So
regions.
arbitrage is a huge arbitrage is that's what the market makers are doing. That's what keeps all of this system in balance, is the huge amount of capital dedicated to arbitraging these markets. And as I say, these are the most difficult markets uh, to arbitrage, because the commodities are disposable, they're seasonal, there's all of these irregularities to them in agriculture in a way that there just isn't in if you're trading iron ore or whatever, right?
Yeah. Now, our arbitrage for those listening, just a quick jump in. It's buy low, sell high. It's taking whatever you can get at a deficit, and that's the wrong way to put it. But again, you're trying to buy it low and then put it into a different market where you can sell it higher and
Well,
actually have a margin on it.
and the difference here between arbitrage and speculation is important. So if you're an arbitrage trader, you're trying to buy the commodity in one market and sell the commodity in another market, knowing that there's a price differential between those two markets, presumably a large enough price differential to cover your cost of transport or whatever cost you might have. Whereas if you're a speculator, you're buying, holding, expecting the price to go up, or selling, expecting the price to go down, and then coming and buying back at what you've sold. So those are two fundamentally different activities. But uh, arbitrage traders they're an extension of market makers, in that the role that they have in the market is to keep the market is to drive the market price to consistency across the regions. Uh, whereas speculators, um, fundamentally, they've got a role in the price in the short term, but because they can't take delivery, or at least very rarely can take delivery, uh, th- their their role in the market is quite limited. What they're trying to do is front run the producers or consumers in response to some kind of event.
Yeah. Okay. So this next one, it's getting out into the weeds a little bit. So I'm totally cool if you say like, eh, I don't know about that. But crop insurance. Do you know? And I'm assuming there might be some differences as well between Canadian side and American side. Do you know how insurance on crops interacts with the CME and with the futures contracts?
Yeah, so crop insurers, um, there there are different ways that these products work. but crop insurers will often become um, hedgers on the CME or competitive futures exchanges. So what they'll say is, I've guaranteed a price to a farmer um, who's growing wheat. So because I've guaranteed that price, I'm going to use either a future or a future option to hedge my risk to changes in that price in order to control uh, in order to limit my financial risk. So I figure that if there's a drought in the Midwest that's going to cause me to have to pay out crop insurance, there's also going to be a spike in the price on the CME. So I'm going to hedge my risk of these insured crops by buying a future or buying a future option, so that I at least get at least I might lose money on the insurance contract I've written, but I'm going to make money on the other side on the future product that I have. Usually, crop insurers will only deal in products on the CME that are financial delivery rather than physical delivery, because ultimately crop insurers typically can't make or receive delivery on a product. So when you see future options or financial futures on what would ordinarily be physical delivery commodities, the target buyers for these products are some combination of speculators and insurers.
All right, absolutely. So for you guys looking to get into ag or considering different areas, what what you immediately see when you get into row cropping? Hmm, let me walk it back. So probably the easiest way for you to do it on the first generation thing is to jump into small small scale farming, consumer focused, and then having people come up onto your property and dealing with things that way. The next step, let's say you're jumping into the 500 acre to 1,000 acre or so, and you're throwing that into row crops. uh, Probably the grain elevator is going to be your next step. And then the grain elevator, you're going to go and they're going to have a set price because they're going to have the storage facilities. You're going to go up, and what's going to happen is that you're going to be selling your grain at whatever price they're offering in the moment. And so there's no actual contractual basis there. And this is separate from dealing with buyers that are going through the CME. Is that a fair way of putting everything to your knowledge as well, Black Horse?
Yeah, so that guy at the grain elevator
I
probably
guess that would be
has.
spot. Would that be the correct way to phrase it?
Yeah, so he's going to give you some discount on the spot price, um, and he's going to give you that discount for the cost of operating his facility, and whatever he needs to take for himself, and he's going to sit on the other side and deliver against a contractual future based on what he expects to collect, something like that.
Yeah, and he would be the actual one dealing with the CME or with
That's
any
right.
sort
The
of
people who
exchange.
deal with the CME do so with a huge amount of scale.
Yeah, that's just amazing because I think I mean this is neither here nor there really, but is it 5,000 bushels is the minimum?
Something like that.
No,
One contract is usually at least $100,000 worth of product, whatever it is.
sure, okay, yeah. Now the interesting thing about that though is what are I meant to look at the futures market earlier today, but let's say roughly you're doing $5 on a bushel. Then what will happen if you're getting if you're getting 100 bushels per acre, then you're going up from there. And so what 100 times 5 is going up to 500. If you got 1,000 acres in there, 500,000. So you're dealing with 500,000 and potentially 5 blocks or 5 units if we're saying that the average unit deal is 100,000. So you get there quickly, but then for us to step into the agricultural area for just a second, the overhead on that is a ridiculous amount. And that's part of the reason that guys will complain about Chicago and they will complain about the prices they're dealing with, but that's not because they're actually dealing with Chicago, but the ripple effect from those prices from the market makers and what's going on with the local elevator, what's going on with the grain sales, excuse me, as in the seed salesman. And so this is all these various areas in which what happens in Chicago ripples throughout the U.S. And then I'm assuming to some degree it ripples in Canada. Is that
Well, it
fair?
ripples internationally because, um, especially for crops that are not highly perishable, um, if you get a price differential between Winnipeg wheat and Chicago wheat, um, an enterprising young arbitrager will discover that there's a train that runs between Winnipeg and Chicago, and they'll figure out how to even out that price differential real quick. So, um, to the extent that you've got relatively non-perishable commodities, uh, the price action that goes on the exchanges ripples out very very quickly, from the largest exchange from the exchanges out to the delivery hubs, and then out to the individual farmers from the delivery hubs, because most people, there aren't a lot of people, I just looked it up. Chicago wheat futures, the minimum contract size is 5,000 bushels. There aren't a lot of guys who are delivering 5,000 bushels reliably. Um, you have to have a lot of scale in order to do that, and you have to have a lot of facilities to make that delivery reliably. Um, it's a lot of organization. So uh, usually there will be some local distributor that then hits delivery for Chicago, and that's kind of how it ripples out from the center all the way out to your local guy. And then the arbitrage players are the ones who are going to um, keep the price at the local farmers market competitive with the price at the grain elevator, competitive with the price at Chicago.
Yeah, and I really we're throwing out a lot of numbers. I don't want the scale to get lost here. Um, and I'm sorry, you said 5,000 bushels. Was that what you were talking about earlier?
Yeah,
And
5,000
so,
bushels is one contract on the CME.
yeah, and what that going from memory here, a bushel is roughly 55 pounds, guys. So I'm
Yeah,
coming up.
136 tons.
Yes, that's where I was headed.
So
136 tons. This is railway movement.
yeah, yeah.
Yep, absolutely. All
So
right.
as I say, to have the logistics to deliver that on a specific day at a specific location, that's not like a trivial thing. So very few end farmers are going to engage with it directly. They're going to engage with it indirectly through this whole collection of systems.
Yes. Now, how? Here's one for you. The market makers. How often is there a changeover in them? Is that daily? Is that hourly? That they're in the pit making, trying to figure out that balance and making different prices, or a is that price locked in for a period of time for 90 days for
No, no, no.
120?
So
Okay.
there's ticks going on. I mean, it depends on the product, how liquid it is,
Hmm.
but like big products like wheat will have a huge number of ticks every day.
Okay. And the tick is just a change in pricing, correct?
A tick is when a buyer and seller meet, and then there's a new price set.
Perfect. All right, very good. So to tie this all the way back to greener pastures, like I was talking about in there, um, it mo- most of what I said holds, especially in the general sense. It all holds. You can speculate and you can chase what's what you think the price is going to move with, especially if you're a grain farmer, because you got to figure after every season you're starting fresh. You have a fresh canvas. Now, to actually get into the nuts and bolts of agriculture, you're not going to do that if you're smart, because each of those seeds has a different impact on the field. And so sometimes you're going to have it completely fallow because you're wanting different things within the soil, the different nutrients to collect and to grow up. And then soy is going to run soil differently than corn is going to run it. And so there's a whole balance in there. And so if you're chasing the pennies, if you're chasing the few dollars difference, what's likely going to happen is you're going to burn out your soil because you're going to be caring for it improperly. And this is just the practical result of what happens when you're chasing Chicago. And so to some degree, you just have to see what happens and deal with it because you're already invested in corn and soy or whatever.
Now, the other thing that is worth noting about the exchange is that if you have enough scale as a farmer, you can use the financial contracts that are on the exchange to hedge your risk. So you put crop in the ground uh, on the predicate that it's going to sell at a certain price. You can then go and sell a future option just the same way that a crop insurer would in order to effectively lock in your price. Now, um, that's a fairly sophisticated financial maneuver. You have to be very careful about the product you're using and so on. But that's the benefit of understanding that system. If you do, is you can effectively lock in your profit or loss on the crop by using the futures contract, right?
Yeah, and those guys in general are going to be part of a co-op or some sort of conglomerate is strong because they're not a technical conglomerate,
Yeah.
but it is going to be some sort of multi-owner organization. But every once in a while, man, those single owner farms that can operate at that level, I mean, it's next level. It's
Yeah, no,
unbelievable.
it makes the game the business of farming much more complicated, but also potentially much more lucrative.
Yeah, yeah, and they're again, when I say next level, it's wild because these are the guys that not only are they aware of pH, not only are they aware of what's going on with their soil, but they are tied in to the whole system, including the financials, the futures, the contractual obligations. So that's go ahead and aspire to that.
Yeah,
But
I mean,
the capital to get there also is going to be very very intense.
well, there's also like business selection. So your podcast is apparently focused on individual producers. But as we've alluded to through this process, there are a lot of other people involved in the agricultural industry besides individual producers, whether it's the grain elevator, whether it's purchasing agents, whether it's like the people who do delivery. There's all of these other parts to the system, whether it's the arbitrage traders who are trading uh, physical commodity in different locations and making delivery in order to take advantage of the price differential. These are all parts of the system that allow you to participate in that market in ways that have potential advantages.
Right. And that's so we got a fellow in the chat, Middleton Whitaker. He's here pretty often, and he said, "I just wanted to grow plants and raise livestock, but as it turns out, I need to be a full time chudjack consulting the graphs." And that
Yeah.
it's funny to think about it that way, but at the same time, what you were just talking about, all these different areas, it is as simple as now. This one isn't technically legal depending on your state, so check your local laws and all that. But it is as simple as saying, I know that John is selling his hogs for $50 a head, and I know if I take him to auction, I can expect $70 a head.
Yeah, exactly.
And so just right there in that small little area, you're already in the system and you are working it to your advantage.
Yes, you're an arbitrage trader and you never even knew it, right?
Exactly. Yep.
So I mean, it's fascinating in that it's a like it's the world's largest complex of markets, but it's also got this tremendous local feel. Uh, I will say that like individual producers, if that's your target audience, tend to do the best when they avoid this system, avoid directly engaging with the system altogether, and are able to deliver their product right to end consumer. Um, because of course, everybody in this whole system is taking their little piece. Um, and so the closer you can get to end consumer, the better you're likely to do financially. Um, Even though obviously operating your own on farm market, or however you're going to get it to consumer, there's cost to that. But the fewer people that are between you and your customer, the fewer little bites are being taken out of you before the cash flows, right?
Yes, absolutely. And I want you guys to hear what he just said, because it really is a big deal in that if you're able to eliminate these different middlemen. So I just talked about getting hogs and then going and taking them to auction. Think about all the different costs that are in there, because at the end of the day it's just simple business. It's profit and loss. But when you go and pick up those hogs, you've got your trailer, which was a one-time cost. You've got your truck, which is an ongoing maintenance cost. There's some maintenance there with your trailer as well, but it's more or less stable. Then you've got all your fuel to get to the auction. At the auction block, you have the auction house that you're paying. Then you have to figure in all the time, because that's always going to be a part of your business. Again, this is all, it's simple business fundamentals, but it's easy to get lost in the momentum of doing it. And so if you can, rather than dealing with all the fuel, the trailering and all of that, if you can pick up piglets in a minivan, I'm not encouraging it, but it can be done. If pick up piglets in a minivan and then you run them on your property, and then you are blessed to live in one of those states where you don't have to get your food USDA cut, but you're
Yeah.
smart enough to butcher it yourself and sell it direct to consumer, you've just eliminated 4 to 6 different middlemen in
And
that
all
process.
those middlemen they've got families to feed. They don't work for free. Um,
Yep.
so it's just, as you say, it's business 101. The more people between you and your customer, the more little bites are coming out of it, the less money is going to end up in your pocket.
Yeah, it's wild. And so then that digs into a whole nother show, which would be margins and what's worth it. Would you rather have 5% of 100,000 or 50% of $100? So
Yeah. Well, and there's, yeah, there's like, because having cash flow has a kind of quality all of its own as well from a business management point of view. Um, I'm not in the business of farming, but I do operate a couple of businesses, and there's a
well,
whole
that
logic there, right?
I was gonna say, you are a business owner, yeah.
Yeah, I am a business owner.
Yeah, and so if you wanted to go on about that for a second, that'd be fine.
I mean, I
I
don't
mean,
talk.
don't
Yeah,
feel obligated, but yeah.
yeah. I mean, I don't talk too much. My business is a very different business. It's not very. We have capex, but nowhere near the kind of capex that you have in agriculture.
Yeah.
We've operated it. I mean, fundamentally, the capital for our business was raised by mortgaging my parents' house. Like, it's not.
Yeah.
Um, it was self financed from the beginning. It's all sweat equity, and it's always operated as a cash business because um, one of the big advantages you have in the U.S. is there's actual like middle tier business credit that's available, whereas in Canada, if getting business credit, unless you qualify to get business credit from the government somehow, getting business credit is extremely difficult. So you kind of have to. I mean, I can't finance even. I can barely finance receivables, much less capital expenditure on the kind of assets that I have to buy. So it's you know uh, running a cash business definitely disciplines you, but it's also a lot simpler to talk about um, because uh, you know there is no capex cost. There's just opportunity cost. Let's put it that way.
I can't even imagine. I, like, so I think well, I think I told you this before the show. I'm not gonna lie, man. There's times where you're looking at your capital and you're looking at your different expenditures and being like, this is dumb. Is it why am I doing this? Because you're running so tight to the line. And I'll tell you, I think I've used this one on the show before, but I'll tell you again. I've got a buddy who in the state runs a very big dairy,
Yeah.
within the top 10 dairies in the state. And he and I will talk sometimes. And he said, my debt gets more zeros
Yeah.
and my net worth gets more zeros, but my bank account
Yeah,
doesn't
but I
have
don't
that.
I don't really
Yeah.
feel any different, you know?
Oh yeah. Oh yeah. So it's a interesting way to live. Frankly, it's broken. And that's praise of folly. It was on here what last week, I think, we were talking about creative solutions to agriculture, because we're going to have some ridiculously large changes to agriculture, to the economy of it, and to the scale of it, if
Well,
it's going to continue.
I mean, I think one of the I mean, so here's my view of U.S. agriculture, big picture. Um, U.S. agriculture is one of these industries that is um, at pains because it suffers from these really large implicit subsidies. Um, so every time you put a piece of infrastructure in the ground from the government, you implicitly subsidize certain kinds of industries. Um, and when California did what they did in the between 1900 and 1950 over water rights, they created an enormous implicit subsidy to growing food in the desert, um, probably not ever imagining that one day the state of California would have the technical capacity to take water hundreds of miles from where it's sourced and irrigate fields that would never naturally grow fruits and vegetables and become the number one state for agricultural production and drive out competition from the much more naturally fertile regions in the Midwest and particularly the East Coast. Um, the consequence of this has been that farming in regions of the country that have been historically very prosperous agricultural regions has become kind of a lifestyle business. And so people do it because they don't want to leave the lifestyle. They've got a large capital asset in the land, something like that. But it doesn't make much economic sense for them to do it because of the huge implicit subsidies that are out there. No different than grazing rights on federal lands all through the Western United States, supporting cattle rearing in areas that it would otherwise make no sense to rear cattle on. Um, all of these implicit subsidies have really done a number on the places where agriculture actually makes sense from a kind of geography and business and sort of natural business point of view. I really think that that dynamic um, is is under threat because of um, the political dynamics of the Western United States, whether it's the political dynamics over water rights in the region, or whether it's just like their crazy commitment to green energy or whatever. Um, I have a sense that that's going to break down, and you're going to see prices on food commodities rise. The other thing that's going to happen here is that um, U.S. The U.S. dollar has this strange situation because it's the global reserve currency where um, it's artificially more valuable than it would be on an exchange basis. This is why the US can sustain this massive trade deficit in perpetuity. The consequence for that for farmers is that their crops struggle to compete internationally. So anything that's like a row crop product that can be shipped overseas without much trouble or come north from Latin America, uh, there's a structural disadvantage for American farmers. Um, and that dynamic is another dynamic that is, um, I don't know how long that's going to go on, and it's going to be enormously disruptive when it breaks, whenever it breaks. Uh, but after that dynamic breaks, the business of farming in the Midwest and on the East Coast of the United States will look a lot more historically normal. And all of these lands. I mean, I drove through Virginia, like the interior of Virginia, far from the coast, um, maybe 5 or 10 years ago, and I found and it amazed me that there's tons of what was at some point farmland that's not under cultivation at the moment, because I guess it's gotten uncompetitive at some point, or maybe the it's being used recreationally or whatever. But if you look back 150 years, there was actually more land under cultivation in the United States than there is today, and particularly a lot more land on the East Coast and a lot more land in the Midwest than there is under cultivation today. And I think the fact the decline, obviously, the population in the U.S. has grown, the demand for food has grown. Even if you account for increased efficiency in farming, I think a lot of that dynamic is just a combination of these implicit subsidies and the artificial strength of the US dollar, making it hard to be in the business of farming.
Absolutely. So I want to address all that real quick, and then I've got something. I don't want to forget this because when I start ranting, I end up forgetting stuff. So I've got something for you after that. Uh, but yeah, so call me an agricultural luddite or whatever, because my whole frustration is when you create artificial climates, artificial environments that ultimately are unsustainable. And so you were talking about the subsidy part of it, which absolutely, and then the practical part of it, because as you hinted at, we are funneling water where water doesn't go. We are creating plants where they can't, or excuse me, we're raising plants where they shouldn't be raised, in my way of thinking, at least, because ultimately, and this actually was a wonderful point that had come up last week when we were talking about energy costs. Todd and I, there's so much energy is being expended on these false climates that eventually it will run out.
Well, I want to make a different point,
Okay.
and this is, I appreciate that the US government is probably not a government that thinks particularly strategically right at the moment. But if you had, let's call it our philosopher king of the United States, they would look at the distribution of U.S. agriculture and say that there's a tremendous risk in having um, such a huge percentage of the country's agriculture concentrated in these artificial climates in places like California.
Yes.
Because if there was a natural disaster, say there's a big earthquake causes a break in the water lines.
Which has been known to happen in California.
Yeah, like you've exposed yourself to food insecurity where food insecurity really didn't need to exist. Whereas if you just kind of um, were a little bit allowed the distribution of agriculture to be a little bit more naturally dictated by the climate, or even just like distributed the subsidies in such a way that you got geographic and climatic diversity, you'd get out of that set of risks. Um, as I say, if you had a philosopher king running the U.S., this is one of the things that I think they would immediately recognize and immediately want to address.
Yeah, well, and it's interesting. Are you familiar with Joel Salatin at all?
I'm not.
Okay, so he is a guy out in the Shenandoah Valley out in Virginia, and he's all about regenerative agriculture, rotating herds, and one of the things that I always like, he said that he's not in the business of raising chickens or cattle or anything else. He's in the business of raising grass,
Yeah.
because if he can raise a good stand of grass, then he knows that he can run chickens through there, or he can run cattle or whatever. Uh, anyways, one of the
Well, it's
things
an
that
interesting way of looking at it because it thinks about your capital asset not as your herd or your flock or whatever. It thinks about your capital asset as the condition of your soil, the piece of land that you actually own.
right, yeah, and one of the things that he's big on, going back to what you were talking about, is diversification, because diversification, one, protects you from a capital standpoint and from a business standpoint, or I should say limits risk. And then on top of that, diversity within the field aids the field, because if you're solely running horses, horses are going to eat in a particular way, and they're going to provide manure in a particular way. But if you're running horses and those horses are followed by cattle, and those cattle are followed by sheep, and those sheep are followed by chickens, and the chickens come through and they're tearing up all the excrement and waste from the other animals, and then the grass was eaten in different ways by those animals, you're providing a way for the system to be somewhat symbiotic and more holistic to the grass itself.
Well, I mean, this is one of there's a whole industry of what I would call alarmists over soil quality who like to point out the fact that because um, soil is extensively chemically supplemented uh, and not supplemented with animals crossing it where it's used for row crops.
Yeah.
You see soil degradation in lots of places, and that soil degradation is managed through the use of fertilizers of various kinds um, that at the moment are cheap, but historically were not cheap. Um, again, this is creating a complex system out of what could be a simpler system. If you know, if you were a little bit more diligent about rotating animal crops and making it a little bit easier to operate smaller scale animal herds, etc. So again, there's a huge opportunity if you had some wisdom from the U.S. government to try to um, instead of absolutely maximizing the efficiency of agriculture, de-risking agriculture a little bit.
Yep.
There's tremendous opportunities you could chase in that area.
Well, and I will build up, and I will say, if any of you guys are doing this, check with your local extension office, your county extension office. Look at the different state initiatives, and then even within. So one, I'm saying that because your extension office usually has somebody who is at least aware of these methods and can point you in the right direction on a state level, of guys that are trying to do more low impact or in particular, low input, more variety of low input farming. But then the other portion would be there are some heads in the USDA, especially within their equip programs and some different sub portions of the USDA, that there are guys that they're trying.
Yeah,
They're
yeah.
they're bringing back a little bit of life to it, and so that's good to see. But hey, I've got a real quick before we start wrapping up. I've got a question for you that you didn't sign up for, but I'm curious.
Okay.
do, do you have any particular thoughts on dollar milkshake?
Uh, okay. So let's talk about what dollar milkshake is, and then what I think
Yes.
about it. So dollar milkshake is the theory that as the U.S. empire suffers disruption, um, the people in the sort of peripheral regions of the U.S. empire, rather than abandoning the U.S. dollar because the U.S. empire is in decline, will instead flock to the U.S. dollar because of the security that it provides relative to their local currency. Because the disruption will happen first at the periphery rather than at the center. So you can see a real life example of dollar milkshake in action over the last month, where um, if you look at the war between Israel and Iran, it's a real symbol of the decline of US power abroad. But in actual fact, the cash flows came from Israel back into the US because the decline in US power was worse for Israel in the short term than it was for the US. Right. So this is the theory that underpins dollar milkshake. Um, and the behavior that it predicts is that as the US empire starts to lose control of its peripheral states, uh, paradoxically, the US dollar will get stronger relative to the peripheral currencies during that period. So that's the theory. Um, my thoughts on this are, I mean, this works solidly on paper, and you can see some real life examples. During things like the European debt crisis in the 2010s, where um, the U.S. dollar has, uh, in the period between 2008 and 2025, the U.S. dollar has become a relatively more dominant global currency, even as U.S. power has declined somewhat compared to where it was in 2008. So there's definitely something to this theory. Uh, there's definitely something to the idea that uh, the U.S. Specifically will become a more important part of the American empire as the American empire declines. Um, all that said, this relies on a very specific kind of decline in American power. Um, One that's kind of non-disruptive and one that doesn't result in political disruption in the United States proper. Um,
Yeah, we're not going Weimar here.
yeah, so the dollar milkshake theory depends on the problems in the U.S. empire emanating from the edges and emanating from either just disorder, like struggles to contain the disorder at the edges of the empire, or competitive states competing at the edges. Um, Not every empire ends that way, right? Many empires have ended from disruption as a result of disruption at the center rather than disruption at the periphery. Um, so um, I wouldn't bet my life on dollar milkshake always being true. But there's some fundamentally sound underlying logic to it, and it in the real life experience of the last 15 years, um, dollar milkshake, the theory behind dollar milkshake has actually played out as expected in a number of cases.
Thank you for that. I sprung that on you, so I appreciate you answering that.
Yeah, and
Uh,
I mean, there's a more complicated way to explain dollar milkshake that, if I wanted to sell lots of books, I could give you. But my view is that a lot of the elements that are sold as part of, like, a lot of the detailed financial part of it is really just obfuscation from the fact that when risk comes at the periphery, dollars flow into the center. It's a property of it's a behavioral property of all of the institutions, and you can kind of map out exactly how that happens if you you know but I don't actually think it's clarifying. I think it just makes it more confusing for no particular reason.
yeah, well, and I appreciate that. It is a particular, it's a particular type of possibility, but it's certainly not guaranteed because there are other possibilities in collapse. So
Yeah, no, and I mean, uh, who knows, maybe the US empire gets stronger for a period, and uh, capital flows back to the periphery to exploit opportunities there. It's hard to say. Um, for example, um, when we were watching the potential closure of the Straits of Hormuz as a result of the Israel Iran conflict, um, one of the things that had my full attention as a Canadian was the question of whether the price of oil would be at a sustained higher level, and therefore dollars were going to flow into Western Canada to invest in the Western Canadian oil patch. Um,
Yeah, well, and that's interesting because as you're talking right now, and I hate to keep having you prognosticate, but it is a question of as these things start as they start becoming less efficient overseas, do you see a great industrial rebound here in the Western Hemisphere? Because it seems like obviously it should occur based on resources that are here, particularly within North America. It seems like it should occur between Canada and the U.S. But
yeah, I mean, these are political questions more than they are practical questions in a certain sense. Um, One of the things that I try to do is I try to carefully watch the actions of the U.S. government rather than what is said over a long period of time. And it does seem that there is a hard pivot away um, from the industrial relationship that they've had with China and the resource relationship that they've had with Asia more broadly. Um, it's less clear to me that there's any long-term strategy for the relationship between the U.S. and Mexico and the U.S. and Latin America more broadly. And I think the question of what a reindustrialization of the Americas looks like in a sort of multipolar environment really revolves around um, whether that reindustrialization takes place in North America, in the historic heart of the American empire, or whether that reindustrialization um, takes place more broadly in the Americas, um, the sort of supercontinent of North and South America. Um, and I think that's a question that remains somewhat unanswered. I was very surprised to see, based on the rhetoric I saw going in on the way into office from the Trump administration, I wondered whether you would get like a real strategic shift to a new model for the American empire that privileged a geographically closer set of allies and like a free trade zone inside that. Um, that's not what we've gotten. Um, we have a kind of confused set of trade rules. Um, that are designed to extract as much revenue for the US government as can reasonably be extracted rather than a systemic industrial policy. At least that's what we have at this moment. And it's hard for me to see where that goes. Um, I, I, I kind of think that American politics are very confused at the moment and likely to continue to be very confused going forward. And it's going to be very hard to make the kind of 20 and 30 and 40-year investments you need for industrial planning in that environment of very confused political underpinnings.
fair enough. Yeah. Well, hey, I appreciate your time. I don't want to capitalize on it too much. I will read real quick. Whitaker jumped in again and he said, by all means, sell lots of books, Black Horse.
There
So,
you go.
yeah, I think we all agree on that. But hey, this was great. If you want to do any sort of shilling and any last piece, if you wanted to put a bow on it, go ahead.
Yeah, sure. If you're interested in my content, you can follow me on Twitter. You can follow my Substack, the Red Ensign, which is really the Red Ensign, both on YouTube and on Substack, is really focused on Canadian politics and Canadian culture. So some of your audience will be interested in that. Some won't. On Twitter, I'm a little bit more broad ranging. I had a show for quite a while with Radlib called Econ Minis, where we looked at economics and capital markets more broadly. Um, it's up in the air whether that's going to restart or not. I'm still waiting on the latest round of Canadian censorship laws to come down before I decide what I'm going to do with that show. So
All right. Well, again, it's greatly appreciated. Everybody go make sure you follow the Black Horse, and I appreciate you tuning in. And we'll talk with you later. Have a good evening, guys.